Hi, class. Welcome to lecture 3.2. This is essentially chapter 7 in your book, and it's basically based on bonds. Now, you see I've listed a whole bunch of practice problems. Obviously, they're there for you. They're not going to be graded, but I do think that these particular problems will help you understand bonds. You also have your test guides and a lot of other wonderful, helpful information. In fact, to give you a couple hints, let's move on to the next slide. As far as exam 3 is concerned, you really should focus on today's lecture. Today's lecture is going to be extremely important. In fact, most of the questions that I'm going to take from for the exam are going to come from this lecture and from your test guide. So it's really important that you pay attention to this lecture. 3.1 is not as important. You could probably even skip it and still be okay. It's just that I think that if you've never even heard of the term interest rate, you're going to want to listen to that chapter 6 lecture so that you have a better understanding of what interest rates are, because they are very important, and they're also extremely important for understanding bonds. If you look at your test guide, you're going to have 40 questions. 30 of those are conceptual, and then you've got the 10 big math questions. What you can really expect is, most of the questions on the exam will look like the test guide, especially the math questions. The conceptual questions are just to give you an idea of what kind of conceptual questions I might ask. And as you will see through here, there will be a slide. I think I actually put it in here twice, called the bond cheat sheet. You really will want to understand that slide. It will help you a lot for figuring out how to solve bond problems. Now, bonds and their valuation. So we're going to talk, if you can look up there at the top, you can see 4 different areas: key features, bond valuation, measuring yield, and assessing risk. Before we go there, though, you might ask, why do I care? Well, do you expect to ever take out a credit card? Do you expect to ever take out a mortgage on a house? Get a car loan? There's going to be a lot of times in your life where you're going to want to understand debt, and bonds are, for the most part, just a debt instrument. It's also important to understand from a macro perspective. Just here recently in July 2015, the national debt is, around $18,150,000,000,000. Okay, that's around $125,000 for each American household, or pushing $60,000 per individual. So if you think about that, $125,000 will buy you a house. So, but instead of getting a house, that's what you have to contribute to the national debt. Now, I do realize that the rich will pay more of this debt, but if you break it down, it is pretty impressive to think about how much debt we each owe for all the money that the federal government has been spending. And what's more important is how quickly this has accumulated recently. It took the country 205 years to accumulate its first $1 trillion of debt, which was in 1981. It has only taken 403 days to accumulate our most recent $1 trillion. Okay, so think about that. 205 years versus 403 days. I know it's really hard to think about some of these numbers, especially if you're not a numbers person, but if you were to sit down and count to a million, it'd probably take you at least 1 week. And if you wanted to count to a trillion, it'd probably take you 31,000 years. Let me repeat that. 31,000 years. Okay? $1 trillion is a huge number, but yet we spend it like it doesn't really mean much. And you heard me recently talk about interest, where we're already spending over $400 billion a year on interest payments alone. Let me repeat that. We pay $400 billion just on interest every year. That's $400 billion that could go to schools for education, maybe give you guys some more scholarship money. It could go to helping out the poor. It could go to, for better roads. It could go to our military or our veterans. But this is going, just to pay the interest on our debt. And this is going to get much worse. If you think about it right now, interest rates are, they're at historical low points, right? We're looking at somewhere around 2.53%. When these interest rates go up, our interest payments are going to rise, just exponentially. Thanks to that wonderful thing we learned about in our last exam called compound interest, right? So if we ever get to a tipping point where we may be actually spending more on interest than we are on even what the government's bringing in, that these are scary numbers to think about. So Now, obviously, we have some time, and we may be able to work out a situation. But the amount of debt that we've been taking out recently, there's no way we can sustain that. We're just not growing fast enough, and so that's some big macro issues. So there's some really important micro issues, personal issues, and some really important macro or political issues that we all need to understand to make sure that we are doing what's in the best interest of our family and our country. Okay. So to make sure we really understand what's going on, the first thing we want to understand are some key features of bonds. So what is a bond? A bond is a debt security that's used to borrow money, usually from a government or a corporation. In other words, investors are going to be the ones that buy the bonds, and they expect to get a specific amount of interest over time, and they want to get that cash they put up back as well, and it's called principal. And they expect to get that principal. It's usually $1,000 at maturity. So you give $1,000 over, get some interest for a while, and also get your $1,000 back at the end. In other words, bonds are usually interest only, meaning the borrower pays interest only but none of the principal. That being said, there are several types, and we will go over all the types as well. For example, one specific type of bond that you can get is mortgage-backed securities, and if you think about it, these are the bonds that got a lot of publicity because they helped contribute to the 2008 economic recession. And if you think of mortgage-backed securities, what are mortgage-backed securities? Well, mortgage-backed securities are you have an asset-backed security that is secured by a mortgage or a collection of mortgages. The big three, as far as mortgage-backed securities are concerned, the big three government-sponsored enterprise issuers are Fannie Mae, Freddie Mac, and Ginnie Mae. And these, there's also an issuer known as Sallie Mae, and Sallie Mae works with student loans. Okay, so most of these were created to help make, affordable housing for, a larger percentage of the population, with the idea that the government would bear an additional amount of risk because, for the most part, these are government guaranteed securities. And we saw that recently when the government did bail out these issuers before they actually went bankrupt. If you want to learn more about mortgage-backed securities, I suggest that you look them up. There's a wealth of information online, and they're pretty interesting. They played a major role actually in the last recession and also in a lot of people's lives. I mean, mortgages are one of the biggest debts that the average American household takes on. Now, I've mentioned a couple big important examples about bonds, but let's make sure that, and bonds are obviously an instrument, debt instrument, but let's make sure we really understand the difference between debt versus equity. First off, there's really no ownership interest with debt. So debt doesn't, debt holders aren't really as concerned with whether or not the company's stock price goes up or down or how much profit they make, as long as they make enough to pay them back. This is obviously different. Shareholders are very much concerned about what's going on with the share price and the profit margins for a company. With debt, you have no voting rights, so you don't get a proxy for any kind of meeting. You don't really have much decision making powers, but you obviously have some say so if you're a major shareholder in a company, right? So common stockholders get to vote, and if you own a big enough interest in a company, then you would definitely want to vote or be participate in those meetings. Now, debt is also tax deductible, so a lot of times people will say, well, why would you even want to use debt? Well, one of the major reasons that you want to use debt is that you get a little bit of a tax shield from using debt, whereas with equity, neither the dividends nor the capital gains are tax deductible. Also, your interest payments are pretty much guaranteed, right? Unless the company goes bankrupt, and so this is a legal guarantee. Whereas even if a company's been paying 3% dividends for 25 years, they're not legally obligated to do that. So you have to be very careful with what you think is guaranteed income from equities, whereas it's pretty much for sure when it comes to debt. Also, debt, too much debt can be a bad thing, right? So, if a company gets in debt too much, then that can actually lead to bankruptcy. But the opposite's not true with equity, right? An all equity firm is actually in pretty good standing from a default perspective. It's not going to go bankrupt. But I do think it's important that we also talk about bankruptcy a little bit. With bankruptcy, debt holders will get paid off first before the shareholders, and so I think it's important to know that you kind of get in the front line if a company does go bankrupt if you're a debt holder, whereas you're in the back of the line if you're a shareholder. So these are the major issues with debt versus equity. The only other major things I can think of off the top of my head from my own personal experience is that the equity market is usually a little bit more liquid, and if you want to go buy a stock, you can go get a stock really, really fast. But when I was buying bonds, it was a little bit more like a used car lot, so you'd go there and you'd want to get a whole bunch of different bids and make sure, because they might not be priced as efficiently as stocks are, but the stock market is extremely, extremely efficient, so stocks are very, very liquid. So this brings me to my point about bond markets. Okay, so there are a couple major points I want you to get from bond markets. Most bonds are going to be traded in the over-the-counter market. And when I was a bond trader, one of the things that I talked to specific brokers, and I'd call a couple different and get, like I said, my best price, and then I would pull the trigger. But I would be buying not just one bond at a time. I would usually be buying like $1 million worth of bonds at a time, and usually these bonds are bought in increments of $1,000, right? So, you know, the bond market is actually much bigger than the stock market, but it's usually owned and traded just among the large financial institutions, right? The big banks and the big brokerage companies. And I would follow, throughout the day on my Bloomberg terminal all the news, and obviously, the Wall Street Journal and other news outlets would report on key developments in the Treasury, corporate, and municipal markets, right? So, there are different key bond markets that you want to pay attention to. And I was, specifically working for a bank, so I was mainly interested in investment grade bonds, bonds that had really high, debt ratings. And we'll get more into that and what's the difference between investment grade bonds versus speculative bonds later in this lecture. Now, there's some basic features of a bond that you really have to know. So you really need to commit some of this terminology to memory. Par value, for example, is the same thing as face value, or on your calculator it's going to be future value. It's the face amount of the bond, and so you're going to, if this was a brand new issued bond, you'd probably pay $1,000 up front, and you'd get that $1,000 at the back. Now, most of the time, if you got on bond market, the bond's not going to be exactly $1,000. It could be worth a little bit more, a little bit less. If it's worth more, then we usually call that a premium bond. If it's worth less, we call it a discount bond. But we'll get more into that. But really, you got to think about par value as $1,000. Okay. And then you have the coupon interest rate, or what I usually just call the coupon rate, and it'll tell you exactly what you should expect from an interest payment, right? So you take that coupon rate and you multiply it by the par value, or $1,000, and that's how you get a coupon payment, right? So if your annual coupon rate is 5%, then you're talking about $50, right? And if it's a bond that pays twice a year, then you're talking about $25 semi-annual coupon payments. The maturity date is going to be your end value here on your calculator, and it's the number of years until the bond must be repaid. The issue date is just going to tell you when the bond first came out. And then the yield to maturity, this is going to be similar to your I button on your calculators, is the rate return earned on a bond that was held, assuming it's held until maturity, right? In other words, this is what you're supposed to get, right? It's your promised yield. This is also equivalent to your APR, which we've seen before when we were talking about, APR versus EAR. And also, because this is supposed to be, up to date with the market, it'll tell you basically what you should be expecting from, current market interest rates. So if you can figure out the yield to maturity on any bond, that is also what current market interest rates should be. Okay, so now that we've gone over a few terms, let's look at a specific bond quote. So what are we really looking at here? What company are we looking at? We're looking at ABC. Now, they may have just using ABC as an example, but that is an actual real company. It's called AmerisourceBergen Corporation. It's in Chesterbrook, Pennsylvania, and it's basically just a drug wholesale company. So, what is the guaranteed interest rate or the coupon rate? Well, that's going to be that next number, your 8.375. So, 8.375%. So if you think of about $1,000 par value, then the coupon payment each year is going to be, just move that decimal over one spot, $83.75, right? When does this bond mature? That's the next number. It's going to mature July 15th, 2033. What was the trading volume? That's the next number, 100.641. What is the quoted price, which is known as the ask price? And that's, whoops, and I can see that I just made a real quick mistake. Sometimes these get ordered in a slightly different way than I was expecting. So you can see here that the trading volume is actually that 763,528 number, which makes a lot more sense. And the quoted price there of 100.641, what does that mean? Well, that's telling you as a percentage of par. So the actual price here is then not $100, right? Multiply that by 10 because it's a percentage of par, and what you're going to see is that it's currently selling for $1,006.41. And then you get, how does the bond's yield compare to a comparable Treasury note bond? Well, what they have there is that 8.316 is going to be the last yield, and then 362 is going to be the basis point difference versus the 30-year Treasury bond. So there's a whole lot of information here. What I really want you to get is to know that you're going to get the ticker first, and then you're going to get the coupon rate, and then you're going to usually get the maturity date. And that's really what you're mainly looking for, and you're going to have to get some kind of a price, and usually they're going to quote that as a percentage of par. The rest of the numbers are often useful as well, but they can show up sometimes in a slightly different order. This is how you would see it usually for like a corporate bond, and then you might see it differently for a treasury bond. For example, here's a quote for a treasury bond, and what you're going to see is that the information is in a slightly different order. 2020, what does that mean? That's when the bond's going to mature, right? February 15th, 2020. What's the coupon rate on this bond? That's going to be that 8.5% number. What is the bid price, and what is the ask price? Okay. So those are going to be back to back. And then how much did the price change from the previous day? And so you got that plus 64 there. And then what is the yield to maturity based on the ask price? Okay, that 3.4730% number. So let's look at the next slide, and I'll lay all of that out for you exactly. All right, so we've already obviously identified the maturity and the coupon. Let's talk a second about the bid price versus the ask price. Now, the bid price is the price at which the dealer is willing to buy from you, whereas the ask price is the price at which the dealer is willing to sell to you. And that difference, why is there a difference there? Well, obviously, that dealer wants to make a profit, and that's called the bid-ask spread. Okay. One interesting thing about bonds is that the investors here are somewhat more traditional, and although a lot of prices for a lot of markets have gone to complete decimalization, bonds are still usually sold in fractional numbers, and they're sold not in by halves or fourths or eighths or sixteenths, but by 32 or 30 seconds. Okay, so if you see here this change, that's what they mean here. What the change is saying is that this change is 64 over 32. Okay, or 32 is the tick size. Once again, the tick is the the amount a price can change, right? So prices here are going to change in some kind of a fraction of 1 over 32, right? And the yield based on the ask price is 3.4730%. Okay, so there's all that information you need there. And once again, what we're really looking for like a lot of the math problems that we're going to be dealing with is price and coupon rates. You get you'll need the maturity date to figure out N, but start thinking about where different things are on your calculator. To help all of you out, I created this slide called the bond cheat sheet, if I were you, I'd print out this specific slide and keep it with me. Not only while you're taking the exam, but while you're, just while you're doing everything, right? Sleep with it, put it, underneath your pillow. This is really going to help you learn how to incorporate what you learned from the last exam to bonds. So basically, you're going to use the same buttons that we did in the last class, your time value money buttons, which I highlighted there with that red box. But the terminology for them has changed somewhat. So this bond cheat sheet is almost, it's like having your own financial interpreter, right? It's a different, little bit of a different language. For example, if you look in that one column that says old TVM, old time value money buttons, you see N, you see I, you see PV, you see payment, you see future value going down that column. You should all recognize that column. The new time value money, meaning this is what you're going to hear when we're talking about bonds, but it's really just those buttons on your calculator, are periods, usually semi-annual periods. Most bonds are either annual or semi-annual, and the vast majority of them are semi-annual, which means twice a year, right? When it comes to interest, you're going to hear a lot about yield to maturity. And the thing you're going to want to know about your interest as well is that that'll tell you what you expect to get on a bond if you hold it to maturity. But that's also the same thing really as APR. And once again, if you can figure out what a bond's yield to maturity is, you also should know what current market interest rates are as well. Okay. Price. Now, if you think about price, that is nothing more than the present value button on your calculator, right? So if you're given the price, you'll plug that in for PV, and if you need to solve for price, then you would obviously solve for PV. So that's what the bond's worth today. Payment, we've talked a little bit about coupon rates. Well, you use that coupon rate to figure out your coupon payment, right? And so, I could have written coupon payment there instead of just coupon, but I like to just say coupon, and I usually denote that with a C. Okay, so and then you get down to future value, and future value is the same thing as par or principal or face value, right? And so let's talk about what these actual amounts represent. Well, in an annual perspective, your future value, which we just talked about, is going to be $1,000. It's going to be $1,000 no matter what, whether you're talking about an annual bond, a semi-annual bond, whatever. It's going to stay the same. Price is going to stay the same as well. Now, you don't know what that is unless the bond was just issued, because when a bond's just issued, it's usually issued at $1,000. But then based on what happens with interest rates, that price could go up or down. You're going to be able to figure out the coupon payment pretty easily. If it's 5% coupon rate, then your annual coupon is going to be $50, right? So you figure out that annual coupon, which I have as a C with a subscript capital A, equal to CR times par. All I did there was take that 5% times 1,000. That's the $50. Now, if it's a semi-annual, then what you're going to have to do is divide that number by 2, right? So it would be $25, right? $25 twice a year. With I, your yield to maturity is just whatever you figure out your yield to maturity at. That you want to usually have that in terms of an annual amount, but if you're solving for a semi-annual bond, you're going to have to divide by 2 as an input. Now, if you solve for yield to maturity, it's a semi-annual bond, then it's going to come up as a semi-annual yield to maturity, and you'd have to multiply by 2 to get the annual yield to maturity. The same situation is true with N, except it's kind of, remember, N is almost like opposite of I as far as the math. If it's years, you're going to put it in as years, no big deal. If it's a semi-annual bond, you're going to have to take years times 2. So if it's a 20-year bond, that would be 40 periods, semi-annual periods. And if you solve for N with a semi-annual bond, it's going to come up as semi-annual periods. So then you would have to divide that number. So if you solve and you got 40, you'd have to divide that number by 2 to figure out this is a 20-year bond. Okay? So that all helps you, understand those last 4 columns. That first column that says sign convention is going to be extremely important with bonds. Beforehand, you really probably didn't get very many of your problems wrong if you were mixing up your sign convention. But with bonds, it's extremely important because you've got 3 different numbers here or signs you've got to get right, which are present value, payment, and future value. Let's talk about each one just to make sure that makes sense. Within, unless you're thinking about inventing some kind of a time machine or something like that, we're going to keep in positive, right? Can you have a negative interest rate? Technically, probably, but we don't really want to think about that as far as this class is concerned. For all the problems in this class, think of a positive interest rate, okay? Unless it tells you otherwise. For present value, this is really going to just make your life a lot easier if you will always, always, always just make your PV negative. Okay, just assume you're handing over cash to buy a bond, and then that you're going to get a positive payment back, and then you're going to get the principal back as well. Okay, and if you'll just always make PV negative with a bond, and then make your payment positive and future value positive, you'll be just fine. Okay, so this is an extremely important slide. You may want to go back and listen to that over and over and over again until you understand the bond cheat sheet, because if you get the bond cheat sheet, you're going to really do well on this exam. Now, there are a couple other terms that you really need to make sure you understand, and we're going to go over each one of those. There are three important rates for bonds. We've already talked about two, right? We talked about yield to maturity, which is your I button. We talked about CR, which is your coupon rate, which helps you figure out the coupon payment, which is your payment button. And then CY. Whoa, what is CY? CY is not one of your buttons on your time value money row. CY stands for current yield. And your current yield is similar to the coupon rate, but what your current yield is it's your annual coupon divided by your price. So it's more like taking that annual coupon and dividing by PV instead of dividing by FV, right? And so make sure you're using your annual coupon and that you're dividing by the price. And this is basically telling you what you're getting now, right? Your current yield. Now, some of you are probably asking the really big question is, why does the price change? Why is your price not always $1,000? Well, one of the big important things you need to understand about bonds is that the bond prices are going to change with interest rates. In fact, they're going to change the opposite direction of interest rates. So as yield to maturity or current market interest rates goes up, prices will go down, and as that yield to maturity goes down, prices will go up. Okay, and that's a really, really important concept. And to explain that, I could do that very easily with, let's take two students in the class. Okay, let's take Sally Sue and Marky Mark. Okay, now Sally Sue has a bond that pays 5%, and it's worth about $1,000, or at least that's what she got it when she that's what she paid for it. Okay. And current market interest rates were 5% when she bought it. Now, if market interest rates go up from 5% to 7%, what's Marky Mark going to do? Is he going to go to Sally Sue and buy her bond? Well, he's not going to want to pay full price for that, because he could go out and pay $1,000 and get a bond that's going to give him 7%. Okay. So he'll go maybe to Sally Sue and say, you know what, your bond's only giving 5%. I'm not going to give you $1,000 for it, but I might give you less. All right, and then the exact opposite would be true. What if Sally Sue's was holding her 5% bond, and then all of a sudden the market's dropped to 3%? Okay, well, then Marky Mark would really, really want Sally Sue's bond, right? Because it's giving you 5%. So he may go to Sally Sue and say, hey, here's $1,000. Can I have your bond? But Sally Sue's going to say, well, it's paying more than all the other bonds are out there, so I'd like you to pay me more than $1,000, right? So if in that case, that bond would be worth more, and that's called a premium bond. So if the bond price goes below $1,000, it's called a discount bond, and if the bond price goes above $1,000, it's called a premium bond. And there are some relationships between these three important rates that you should need to know, based on whether you're looking at a par value bond, meaning a bond that's selling for $1,000, a discount bond, or a premium bond. So at par value, all three of these rates should be the same: yield to maturity, the coupon yield, the current yield, and the coupon rate. They should all be the exact same. With a discount bond, meaning your price is below par, the yield to maturity will be the highest, and then next will be the current yield, and then the coupon rate. And then if you have a premium bond, the yield to maturity would be the lowest, the the coupon rate would be the highest. Okay. Now, it's very important to understand this. How would I ask a question like this? I give you a very good example of this with problem number 31 on your test guide, so make sure you take a look at it. Now, this next slide here, the value of financial assets slide, it's probably not going to be that important for most of you. I really stress the importance of that bond cheat sheet and all the information we just went over. But if you want to see a timeline, see how you might go about valuing a financial asset, this is really important. And we got a graph here that might help show it as well. So if you look here specifically at figure 7.1, the timeline for Allied Food Products bonds with a 10% interest rate, what you're going to see are all the specific payments and how they were discounted back to the present value. And so if you look, that first payment was discounted from $100 to $90.91. So it didn't have to be discounted that much because it only went back one period. But as you go down, each one's getting discounted back from a further point in time, so it's going to be worth less, except for that last payment. That last payment, if you look, is $239.39. Why is it the biggest payment? Well, if you look, it's got two little arrow points there, and that's because you got not only your $100 back, okay, but you also got that $1,000. And so if you look, that last year, or that last payment, you got not just that $239.39, but you also got a payment for $23.94. Okay, that $23.94 represents the $100 interest payment discounted, all the way back, and the $239.39 represents the $1,000 par value or principal discounted all the way back to present value. If you add all those payments up, then what you have there is $1,000. So, in this situation, the present value of this bond is $1,000. Okay, so now that we've kind of gone over some of the math involved with bonds, which, by the way, once again, I stress that's really going to help you a lot with the math problems on the test guide. Let's talk about a few more features of bonds or different types of bonds. The first one is the bond indenture. And that's really just the contract between the bondholder and the issuing company. It's referred to often as the deed of trust. It's going to lay out all the basic terms of the bonds, the total amount, whether it's secured versus unsecured, if there are any sinking fund provisions. It's also going to talk about any kind of call provisions. We won't get too much into some of these nitty-gritty details of bonds. I just kind of want you to know the basic definitions, which you obviously can look up. It's also going to list if there's any details of protective covenants in there. So if I go over any of these definitions here too fast, you can obviously look them up. That's basically all I want you to know. Let's start with the difference between a secured bond and an unsecured bond. Okay, so a secured bond is going to have some kind of collateral backing it up, very much like with a mortgage. The house backs up that mortgage as collateral, right? Or with a car loan, the car is often the collateral. But with unsecured debt, that is basically just based off the reputation of the company that issued it, and credit ratings obviously matter quite a bit, and that's obviously true also with with a lot of government debt as well. A sinking fund provision is a provision that requires that part of that principal repaid each year as well as the interest. And maybe one of the best examples here is very much like a regular 30-year fixed rate loan on a house, right? So a mortgage, because usually what you're trying to do there is pay not only the interest but also pay a little bit of your principal back. Eventually you're paying more principal than interest, but you're trying to pay it all back over time down to zero, and so that there's not this big payment at the end, right? Now, the difference between a sinking fund provision, though, and your typical mortgage is a lot of times you're setting up like a side account here where they're just the issuer is having to put money into that little fund on the side that shows that they are contributing to paying back that principal down the road, and that money can often be invested in something as well. But that way, if a company ever fails to meet this sinking fund requirement, that's usually going to be a sign that something's wrong with the company, or it could even trigger a default, which could could even throw that company into bankruptcy. So think of a sinking fund provision as a mandatory payment. In most cases, the issuer can handle a sinking fund payment in one of two ways. The first way is that the company can call in for redemption at par value that required amount that they're supposed to get within the bonds, right? So if they have a $1 billion issue and they're required to buy back say $50 million bonds, $50 million of bonds each year, then they can call in for redemption at par value the required $50 million of bonds. Okay. The other thing that they could do is that they could go out and buy the required number of bonds on the open market. And it's really up to the firm, and they're probably going to choose which one costs the least amount. For example, if interest rates have fallen since the bond was issued, the bond will sell for more than its par value. And if interest rates have risen, the bonds are going to sell at below their par, right? And we just talked about this inverse relationship between price and interest rates. Now that might be somewhat confusing, and I'm not really concerned that you understand how sinking fund provisions work specifically, although the one thing I do want you to understand is that sinking funds provisions were designed to protect the investor, really with the concept that if a steady amount of the principal was retired in an orderly fashion, that this was somehow protecting them or decreasing the amount of risk involved. In other words, most bonds that have a sinking fund provision are regarded as safer than those that do not have that provision. And that's really what I want you to understand. There are also call provisions, which is nothing more than a rule that allows the bondholder the right to redeem the bonds under a specified term prior to the normal maturity date. And what that means is, you've got the right to redeem this bond before the maturity date based on specific requirements. Usually the bondholder is going to have to pay more than par in this case, and that's usually what's referred to as a call premium. And usually there's a waiting period before a bond can be called, and that's usually what is referred to as deferred call. And having a deferred call provision is also something known as call protection. And then finally, the term protective covenants, that just represents a part of an indenture or loan agreement that is going to limit certain actions a company may take during the term of the loan, and done to protect the lender's interest. Although they can also be there to help protect the bondholder as well. Now, bond covenants are designed from both a negative or a positive perspective. And so let me explain those. Like a negative or restrictive covenant usually forbids the issuer from undertaking certain activities, and a positive or affirmative covenant usually requires the issuer to meet specific requirements. Okay, so there's some extra terms that I just threw in there for But if you want to know more about bond covenants, you can, and especially the details here, you can certainly look in your chapter. But that's pretty much all I want you to know about bond covenants, other than what I'm about to go over in the next few slides. Okay, so there's a few more terms in your book. There's convertible bonds, there's warrants, there's income bonds, there's index bonds. The list goes on, and there's actually just a really long list of different types of bonds and different types of covenants and different things involved with each unique type of bond. And you can look in your chapter and find out all the information you want about these bonds. But if I don't really talk about it in this lecture, then don't assume that that I don't think it's important. Just assume that I don't think it's required for you for this class. All right, let's talk real quick about prices and the quoted price versus the invoice price. And what's important here to remember are the terms clean price versus dirty price. So the clean price is going to be the quoted price, and the dirty price is going to be the invoice price. Okay, we've already talked about the ask price, and the bid price and the bid-ask spread. But the quoted bond price, or that clean price, is going to be net of accrued interest. Okay, and so the accrued interest has been taken out. Whereas the invoice price, or the dirty price, is going to actually include that accrued interest. And what is accrued interest? That's interest earned since the last coupon payment is owed to a bond seller at the time of sale. What does that really mean? That accrued interest is really, if I buy a bond today and I'm halfway between or in the middle of a coupon payment, I have to pay back that half to to the seller once I get that interest payment, right? Because that seller was holding the bond during that time, and that seller deserves that interest. So you have to be careful with accrued interest and understanding, that if you hold the bond for the majority of the payment, you're going to get the majority of the interest. But if you only hold the bond for a small period of a payment, then you're not going to get most of that interest. You're going to actually owe most of that interest in the form of accrued interest. So once again, the quoted price is the clean price. The invoice price is the dirty price. The difference there is accrued interest. So let's go over a few quick bond classifications. You've got registered versus bearer bonds. Obviously, registered bonds are going to be registered. Bearer bonds are actually going to be unregistered. And so this is almost like cash in a lot of ways. There really are no records kept of the owner or the transactions involving ownership. So these type of bonds, are commonly discussed in like James Bond movies, right? So, come to this poker game and bring me a suitcase full of bearer bonds, right? And so just remember that there are registered bonds, and then there are bonds that don't have to be registered. Now, what are some ways that you can actually secure bonds? Well, we've talked about collateral, and obviously, those are used as some kind of asset to back a bond. So, for example, with a mortgage, you'll see it secured by real property, normally, land and probably a house or some other buildings like barns or other structures. Debentures are long-term bonds, and they're usually not secured by a mortgage or any kind of specific property. And then notes are usually even shorter term, right? So they're unsecured debt with original maturity less than 10 years. Seniority when it comes to debt is really based on who gets paid off first, right? And we've already talked about the fact that, looking at debt versus equity, that bondholders get paid back before shareholders. But it's also important to know that there can be seniority within debt. So senior debt is going to, have debt holders that get paid off before junior debt. Junior debt is a debt that is either unsecured or has lower priority than the senior debt. And this is usually based on, the same asset or property. It's just different status here. So in other words, it's really just a debt that's in lower repayment priority than senior debt. Similar to junior debt, you have subordinated debentures. These are bonds that have a claim on assets only after the senior debt has been paid full, in the event of a bankruptcy or liquidation, right? And that's really easy to remember because subordinate is a term that really means below or inferior to. So if you remember that subordinated debt is obviously going to be below that senior debt. Okay, so I mentioned what a sinking fund was earlier on, and now that I've got this slide, here I've listed the things that I really want you to remember, right? It's a provision to pay off a loan over its life rather than all at maturity, right? So you're paying a little bit over time, which is, kind of like a mortgage or amortization term loan. And the real reason for this is to reduce risk, right, for the investor, okay? The only major caveat is it's not really good for investors if the interest rates decline after issuance. For example, suppose the bond has a 10% coupon, but similar bonds now yield only 7.5%. A sinking fund call at par would require a long-term investor to give up a bond that pays $100 of interest and then to reinvest in a bond that pays only $75 per year. So this is really a major disadvantage to those bondholders whose bonds are called. Okay. Now, with all that being said, remember, bonds that have a sinking fund are usually regarded as safer, and that's really the point that I want you to take away. Now let's take a look at how sinking funds would be executed. As I mentioned before, you can call in for redemption a certain amount, right? So if you look here at call X percentage of the issue at par for sinking fund purposes, and then you might use this if R is below the coupon rate and the bond sell at premium, okay? Or you can go out and buy the bonds in the open market, and this is likely to be used if R is above the coupon rate and the bond sell at a discount, right? So it's really kind of just two ways of doing a sinking fund based on what's going on with interest rates and the price for a bond. Now let's take a look at the effect of a call provision. Okay, there's three major points I want to make sure that you got, even though I talked about this a little bit earlier. Call provision is really there to protect not the investor but the issuer, right? So this really allows for the and I want to make sure I said that because I might have confused you earlier. It really protects the issuer, not the investor, right? So this is for the company that issued these. It allows them to pull these bonds back at any time if they want to, and they're usually going to do this if rates go down. Now, why would anybody ever get into a callable bond? Well, there's more risk involved here, so a lot of times these investors can demand a higher yield on callable bonds. Okay. There's also a couple things that help out the investor in this case. Usually, these types of bonds are going to have, any kind of call provisions are going to come with a deferred call provision, which means there's going to be a period of time where the bank or the company that issued the bonds can't call these bonds. Also, there's usually going to be a call premium, which can be equal to up to like 1 year's worth of interest. And so that's kind of like we call these bonds. Here you go. Sorry about it. And so that can be really important. And you also might see where the bond holder might actually have to pay a price that's higher than par, right? So there's all kinds of ways to make this fair on both sides of the equation. Why would somebody maybe not get into a call provision? Well, when I was a bond trader, one specific reason I never wanted to deal with callable bonds is because of reinvestment rate risk. I didn't want my bonds that I was invested in to get called, and then I'd have to go out and figure out something else to invest in, right? Those issuers that put callable provisions into their bonds also have to pay attention quite a bit to interest rates and see, if rates have declined to the point where they want to call those bonds. So it requires a little bit more active management on both sides, and so that's one of the reasons that a lot of times you won't see a call provision in a bond. Now let's take a look at federal government bonds. So the main thing I want you to see here is the difference between T-bills, T-notes, and T-bonds. Bills are going to be anything less than a year. Notes are going to be between 1 and 10 years, and then bonds are going to be anything that's greater than 10 years. And I've seen where notes might sometimes be only between 1 and 5 years or whatever, but for this class we'll consider 1 to 10 years. And that's really what I want you to get from this slide. So if you look at this Treasury yield curve too, one of the things that you're going to notice is that interest rates have declined quite a bit over a course of 1 year on this graph, right? And that can obviously happen. This happened following the Great Recession, and that's why interest rates have been at what we might consider all-time lows. But also notice that as you get further out into maturity, that those interest rates are going to go way up, or at least there's going to be a substantial difference there. And that is what you should expect, right? Unless you get in a period where you might have like inverted interest rates. But for the vast majority of the time, you should expect an upward sloping yield curve. I also want to take a second and talk about municipal securities. And this is debt that's issued at the state or local level, right? And the major thing that I want you to know here is that interest that is received from these bonds is going to be tax exempt at the federal level, and it's going to also usually be exempt from state tax as well. Okay. Now there's two real points I wanted to point out about municipal securities. One is a highly compensated business owner already in a high tax bracket might purchase muni bonds to receive tax-free income. At that example, what does that mean? What they're saying there is that municipal bonds are really effective for the folks that already have a really high income and they're trying to avoid extra taxes on their income, right? Now, if you don't have high income, say you're retired or whatnot, then maybe these wouldn't be as important to you. But if you're making a lot of money and paying really high income taxes, then a muni bond might be more important to you. Another thing to think about is that these are not necessarily guaranteed. These are not as guaranteed as at the federal government level. You've seen major cities go bankrupt. You've seen Detroit declare bankruptcy. You've seen Birmingham, Alabama declare bankruptcy. You've seen a number of issues with cities in California. So I would say there's more risk involved with muni bonds than there would be with federal bonds, such as the Treasury bills, Treasury notes, and Treasury bonds. So let's look at an example. A taxable bond has a yield of 8% and a muni bond has a yield of 6%. If you are in a 40% tax bracket, which bond do you prefer? Okay, this would be a good surprise exam question. So if you've been listening, hey, good for you. If you're in a 40% tax bracket, which bond do you prefer? Well, you would take that 8% and you're going to subtract off 40% from it. So now you've only really made 4.8% on that taxable bond. Okay? And whereas the muni bond still stays at 6%. So which of those two would be better? Well, in that case, the muni bond. And then at what tax rate would you be indifferent between the two bonds? Well, if you see how you can solve for this by just solving for t, the tax rate, by setting 8% times 1 minus that tax rate equal to 6%, and you're going to find it 25%. So once again, if you're at a really high tax rate, the muni bond worked out well, but if you're at a tax rate below 25%, then you would probably rather stay with the taxable bond. And so this is a perfect point or a perfect example to illustrate why those folks with high income taxes might prefer muni bonds. I could see both a math problem here and a conceptual problem on the exam. Speaking of a topic that you'll definitely see some problems on the exam, zero coupon bonds are really important for this class. Let me start by asking you a question. How much interest do you think you'll get from a zero coupon bond? Well, the truth is that you're going to get zero, right? It's a zero coupon bond. So, make sure that you don't confuse yourself more than needed here. The title tells you everything. It's going to pay you 0% coupon rate, so you're not going to get any kind of periodic interest payments. This means that the entire yield for these type of bonds comes from essentially capital gains, meaning what you paid for it versus what you get when it matures. And in a strange way, these bonds are somewhat more like stocks in that you are, especially growth stocks or stocks where you're looking mainly for capital gains. But the neat thing is that you know exactly what to expect to get when this bond matures, right? So it's almost guaranteed capital gains. These bonds are often called deep discount bonds or zeros. Because no one would buy them for more than par, right? Because you're going to get par when they mature. So you're going to buy these bonds for $100, $200, $300, $400, $500, some kind of deep discount, and then hold them until they mature and get your money back. And and in some cases, these bonds were used in the past to hold and as a savings vehicle for children for going off to college, because you knew that you'd get the $1,000, so you could buy them to where they would mature each of the 4 years that a student would need them to go to college. And then two good examples would include Treasury bills and U.S. savings bonds, right? Now, it doesn't mean that other countries can't. Any other country that wants to issue zeros has that right as well. And then one really kind of just fun fact, interesting caveat, is that these bonds have what's called phantom interest. In other words, they create annual tax deductions for their issuers and annual taxable income for their bondholders. Right? So let me say that again. They have phantom interest, which creates annual tax deductions for their issuers and annual taxable income for their bondholders. And it's just, used a legal stipulation, right? That the federal government created these rules, and we just have to follow them. But this is pretty neat, and I want you to know about that phantom interest. Now, previously I'd mentioned when we were talking about bond covenants that there were other types of bonds out there that have different rules and regulations with them. For example, there's a convertible bond, and all I really want you to know about a convertible bond is it basically creates an option for the holder, and it allows them at some point, if they want to exchange their bonds for common stock. The math can get pretty complicated, but the idea is pretty simple, and that's really what I want you to know. Now, convertibles, usually offer investors the chance for capital gains if the stock price increases. Now, why would the issuer ever give that, option? Well, because it usually allows them to offer a lower coupon rate than non-convertible debt with, similar credit risk. Now, warrants are very similar to convertibles, but the main difference is that instead of giving that investor the option to exchange the bonds for stocks, Warrants give the holder an option to buy stock for a stated price. In other terms, warrants are long-term options to buy a stated number of shares of common stock at a specified price. And since these are another option, they're going to have a similar effect in that bonds issued with warrants, just like with convertibles, are going to carry lower coupon rates. Puttable bonds are a provision that allows investors to sell them back to the company prior to maturity at a prearranged price. In other words, if interest rates rise, investors are going to put the bonds back to the company and reinvest in higher coupon bonds. And then income bonds are bonds that pay interest only if it is earned. In other words, income bonds, they can't really bankrupt a company, and so, say for example, you buy some bonds on a toll bridge or something like that. If nobody ever uses the toll bridge, then they would never have to pay any money. But if everybody's using the toll bridge, then there's income generated, and so these income bonds would get paid interest. Finally, there's indexed bonds or purchasing power bonds. Here we're talking about bonds that have interest payments based on an inflation index like the CPI, Consumer Price Index, so as to protect the holder from inflation, right? One of the most common examples here would be TIPS, Treasury Inflation Protected Securities, and that could be a good exam question as well. So what would be an example of an index bond? A Treasury Inflation Protection Securities, or TIPS, okay? And the idea there is simple. They're just going to protect that investor from rising inflation. Now, how much money do TIPS pay or something like that? You're not looking at much, right? You're looking at a return that's usually between 1% to 3% plus whatever inflation is for the last year. So, this isn't a way to get rich. But if you are concerned about inflation, this is certainly a way to protect yourself. So those are 4 other main types of bonds. Or I guess I should say 5. Those are 5 other types of main bonds. Okay, so switching gears a little bit, what is the opportunity cost of debt capital? Well, the discount rate here, big R subscript I, is the opportunity cost of capital. And it is the rate that could be earned on alternative investments of equal risk, right? So how do you go about finding this out? Well, you've got a lot of different premiums here that you're going to add in. The first thing you're going to add in is with that star or asterisk. Now, don't get too confused by this equation. You don't have to have this equation memorized in any way, shape, fashion, or form for the exam. What I want you to see, though, is that there's a lot of different premiums involved. So before you get confused, just almost kind of wipe that equation out of your mind. Just know that there's a bunch of different premiums or factors that affect interest rates, okay? And let's take a look at what those are in the next slide. Okay, so here are the 4 factors affecting required return. The default risk premium, the taxability premium, a liquidity premium, and a maturity premium. And as long as you know these, then these are one of the big points that I said from Chapter 6 that, or from Lecture 3.1 that I would expect you to know for the exam. Okay. You might also want to go back and look at Lecture 3.1 and see who's affected by which as far as corporations versus federal, Treasury type bonds, right? Because if you think about this, you don't have to worry about the federal government defaulting, but you do have to worry about that. So just be aware of, which bonds, which of these premiums are going to affect which different types of bonds. And other than that, as long as you know the basic definitions, you're covered. If you're confused, I went over this in pretty good detail in Lecture 3.1. Okay, so as you can see from this slide, we're going to talk about the Fisher equation. Now, I'd also like to point out that there are a couple problems that on the test guide, problems 15 through 17 are some conceptual problems about the Fisher equation, and then number 36 on the test guide is a math problem that'll show you a little bit about the Fisher equation. But really all we're talking about is the relationship between real rates, nominal rates, and inflation. So big R is your nominal rate, little r is your real rate, and H is your expected inflation rate. So there's a rule of thumb where you could just figure out big R by by adding little r plus h, right? So if the real rate was 3% and inflation was 1%, then your nominal rate would be 4%. A better way of maybe looking at this, though, would be figuring out what your big R is. You can solve that using your calculator, and maybe you would have figured out that that was 4%. And then you took off 1% for inflation, and then you're left with your real rate. So a lot of times you're going to actually solve for the real rate, or little r, using these equations. So you might want to go ahead and rearrange those for little r. Now, what I just described is the approximate equation. Okay, the real Fisher equation is 1 plus big R, all in parentheses, right, equals 1 plus little r, all in parentheses, times 1 plus h, all in parentheses. Make sure you notice there is no plus or no addition sign between 1 plus r and 1 plus h. Okay, that is a product right there, right? They're being multiplied. That's probably the most common mistake I see when folks go to use the real Fisher equation, simply because they have looked at the approximate equation and gotten used to that addition sign between the real rate and the inflation rate. Okay, this is just what is the real rate? Remember, the real rate just takes out the inflation so that you can see how much your purchase powering has changed. Okay, looking at the Fisher equation example we have here, if we require a 10% real return and we expect inflation to be 8%, what is the nominal rate? Okay, once again, if we were going to use that approximate rule, we would just add 10%, which is little r, plus 8%, which is h, and you're going to get 18%. So we'd be expecting somewhere around 18%. And that's a lot of inflation too, right? So that would be a really big R. Now, to figure it out exactly, though, you could do 1 plus 10%, or 1.1, times 1 plus 8%, which is 1.08, and then you're going to have to subtract 1 from both sides. So that's going to give you the exact return for big R of 18.8%. Now, usually you'll get a much closer number between the Fisher equation and the approximation. In this case, though, we really had some extremely high numbers for real return and for expected inflation. And so in this case, you had almost a full percentage difference. So keep that in mind. Now, as you can see up at the top, we have switched into the bond valuation portion of this presentation. For the remaining slides, I'm going to actually go pretty fast. The main reason for that is if you look at my lecture notes, which I've also posted, you're going to see there's a lot of practice problems as well. So, for example, with bond valuation, you're going to see a majority of those 10 math problems will fall into this category. But let's look at something real quick. What is the value of a 10-year, 10% annual coupon bond, okay, if R equals 10%? Now, you could plug each of these in your calculator, but right here they're showing you how you could solve it using the equation. I could tell you just from working enough bond problems that the answer here is going to be par. That the value here is going to be $1,000. The present value will equal the future value. Why? Because if you look up there, they told you in the problem that the annual coupon rate is 10%, and then the R, which is going to be your I button or yield to maturity, is 10%. Whenever that happens, both the future value and the present value are going to be the same. But if you don't believe me or don't understand me, you can definitely use the timeline or the equations below, or, as we'll see on the next slide, remember you can use your bond cheat sheet. So remember, use the bond cheat sheet. Here it is again. I put it in this lecture twice for a reason. I would print this out and use this to do all of the bond problems that you're going to do as well. I think there's like a Fisher equation problem, but most of those 10 problems you'll need the bond cheat sheet for. All right, just to prove that the future value and the present value would equal 1,000, go ahead and put these into your calculator, and you can see the inputs and outputs on this slide. And I'm not even going to read it all again, but you're going to put in 10 for N, 10 for I. You put in 100 for the payment. How did I get the 100 for the payment? Well, that was the 10%. Use your bond cheat sheet, right? That's 10% coupon rate times 1,000 par. That's where that $100 comes from. Future value is always 100. Solve for present value, and you're going to get negative 1,000. Okay. All right. So once again, 10 for N, 10 for I, 100 for payment. And I think I might have just said this wrong for future value, but future value is always par, which is always 1,000. And then present value, you solve for that, and you'll get negative 1,000, just like the future value was 1,000. Okay, so what's the value of its 10-year bonds outstanding with the same risk, but a 13% annual coupon? Okay, well, what do you do here? You're just going to take the 13%, multiply it by the par, which is 1,000. You're going to get 130. So very similar situation, except you're changing your payment to $130. When you solve for present value, you'll get $1,184.34. So this would mean that this is a premium bond. I know it says negative. Just kind of remember that it has to be negative, and but the price for this bond is really $1,184.34. What's the value of its 10-year bonds outstanding with the same risk but a 7% annual coupon? Okay, well, once again, everything's going to stay the same, except you're going to change your payment to $70. Why? 7% times 1,000 is 70. Okay, and you'll solve for your price or your PV, and you're going to get $815.66. So, what you've just seen here is that if you lower the coupon payment, you're going to lower the price. Makes sense, right? This bond's paying me less, I'm going to pay less for it. And if you raise the coupon payment, then you're going to raise the price. So this brings us to some overall stuff about bond value. Okay, bond value equals the present value of coupons plus the present value of par. Okay, or you could say bond value is the present value of an annuity plus the present value of a lump sum. Another way of saying this for me is just to say that bond value equals the present value of all the payments, okay, plus the present value of the future value. Okay, so you're just looking at discounting all future cash flows. All of those steady payments you're going to get discounted back, and then that one principal payment that's your future value or par value then is going to get discounted back as well. And that's how you figure out price. Okay. Also remember that as interest rates increase, that your price is going to decrease and vice versa. So this slide really has, a couple of really important tidbits of information that I could see, asking one or two conceptual questions on the exam from. Just in case you want to see what this looks like in equation form, what you're going to see is it looks a little bit nasty as compared to some of the other equations we've seen, but really all you're doing is you're going to get the present value of an annuity, use that equation, okay, and that's for all those steady payments, and then you're going to get the present value of a lump sum, okay, that's just one-time value money problem, and you're basically adding both of those together to get the present value. Okay, so try it with the equation form too if you want to check your work. This would also be important if you're trying to figure out an equation to put into Excel. Okay, so this is a really good slide to show you what really happens with bond value over time. So those three examples that we just looked at before, remember the first one we started with a 10% coupon rate, and you can see that over time, if you maintain a 10% coupon rate, and also notice that in the bullet point it's saying that interest rates are staying at 10%. So if the coupon rate and current market interest rates stay the same, your bond's price is not going to change over time. Okay, that's why you got that straight line for 10%. However, if you look at the 13%, you're going to get a big change up to that $1,184, which we found out before. And if if with a coupon rate at 7%, it's going to be worth $816. But what's weird, or at least you should notice, is that over time, you see that kind of like bullet there of whereas the the upper line and the lower line eventually converge together. Why would that be happening? Why would eventually these both of these bonds with a 13% rate and the 7% rate slowly approach $1,000? Think about that for a second. The reason should eventually become obvious. Remember that once that bond matures, you're going to get your $1,000 back, right? So as you approach maturity, regardless of what your coupon rate is, you're going to approach $1,000. So it's important to remember that at maturity, the value of a bond must equal its par value, right? That regardless of what your coupon rate is, when you get to maturity, this bond's going to be worth $1,000, right? Now, if interest rates remain constant, the value of the premium bond will decrease over time until it reaches $1,000. The value of the discount bond is going to increase over time until it reaches $1,000. And the value of a par bond stays at $1,000. And a good example of this would be, remember we talked about zero coupon bonds? They don't even pay any interest, right? So they're going to stay steady with that big fat 0%. But if you watch the value of a zero, it's going to go from whatever you bought it at. Let's say you bought it at $200. And it's just slowly going to race towards $1,000, at maturity, because you're going to get paid the principal back when it matures. All right, this slide just shows you a table with all the numbers in case you're interested in looking at them and seeing how the prices for all three bonds are going to converge closer and closer and closer towards $1,000. Here's another slide straight from your book that's going to show you, essentially the exact same thing. Okay, class, now we're really shifting gears into measuring yield. So what is the yield to maturity on the following bond? 10-year, 9% annual coupon, $1,000 par value, selling for $887. So the first thing I'll do in my mind is say, well, what do I have? What's given here? 10 years is my N. What is that 9% annual coupon? That 9% annual coupon tells me that I'm going to be paying a $90 payment, at least annual payment, right? The $1,000 par value is just my future value, and the selling for $887 would be negative $887 for my present value. So I've got 4 of the 5 things. All I need to do in my time value money buttons would be to solve for I. This right here also shows you how to do it using the equation. So either way you want to do that. Now if, like me, you'd like to use your time value money buttons because it's quicker and easier, then right here shows you the inputs and the outputs. Okay, so this would have been a pretty easy problem. You put in 10 for N, negative 887 for present value, 90 for payment, 1,000 for future value. Compute I, and you get 10.91%. So what if we change the bond price to where it's a premium bond, right? And let's change that to negative 1,134.20 for present value, and then hit compute I. Notice that I now is going to go all the way down to 7%, and that should show you right there that if you raise the price, that means the interest rates went down, and whereas beforehand the interest rates were really high and the price was really low, right? There's that inverse relationship. Always remember that. Okay, so once again, let's go over the some major definitions. The current yield is that annual coupon payment divided by the current price. The capital gains yield is going to be your change in price over your beginning price. All right, and then the expected total return is your yield to maturity. Okay, so to get your yield to maturity, all you have to do is add your expected current yield plus your expected capital gains yield. Let's take a real quick example. Find the current yield and the capital gains yield for a 10%, for a 10-year 9% annual coupon bond that sells for $887 and has a face value of $1,000, right? So, to find the annual coupon payment first, that's 9% times 1,000, so you put $90 in the numerator. $887 is going to be your price. That would go in the denominator, and you're going to get a current yield of 10.15%. Now, to get your capital gains yield, you could figure that out simply by rearranging the equation. Yield to maturity equals current yield plus capital gains yield. So if you find the yield to maturity, which we already found a couple slides ago, minus the current yield, which we found in the very last slide, you're going to find a capital gains yield of 0.76%. Now, you could have also figured this out by just taking the expected price 1 year from now and dividing it by the change in price by the beginning price. Okay, so those were a couple ways that you could measure yield. How could you go about assessing risk? Well, one of the things that we really need to talk about is price risk. And what is price risk? Price risk is just that you're worried that interest rates may go up, so your price might go down, right? So you have to be worried about what interest rates may do to prices. So which type of bond do you think would have more price risk, a 1-year or a 10-year bond? Well, right here you can see that the changes between a 1-year bond, it's not as big of a deal as the changes between a 10-year bond. So a 10-year bond is definitely going to be more sensitive to interest rate changes and hence has more price risk. Makes sense, and we've talked a couple of different reasons why long-term bonds can sometimes be riskier than short-term bonds, and one of those reasons is price risk. So once again, there's a few things I want to point out about price risk. 1, it's a change in price due to changes in interest rates. 2, long-term bonds have more price risk than short-term bonds. And 3, low coupon rate bonds have more price risk than high coupon bonds. Now, we didn't mathematically talk about that in the last slide, but it is true, and you can obviously play around with your calculator and figure this out. It could also be just pretty intuitively obvious, because if think about it, if you got a bond that's paying a high coupon, that's a pretty good thing, and so it's definitely not going to be as affected by any changes in interest rates because it's more likely to still be a good bond since it's paying the high coupon rate. Those low coupon rates, though, are you've got to be a little bit more nervous about them. Here you have a small figure graph here that illustrates price risk. And here's a very similar graph straight from your book, and it's showing pretty much the same thing, except instead of with a 10-year bond, you're looking at a 15-year bond. Now, one of the things you're going to notice here is that there's a lot more volatility with the 15-year bond as far as prices are concerned than there is with the 1-year bond. That volatility is a measure of risk, and you can see here that there is going to be more risk involved with a 15-year bond than with a 1-year bond, which looks very steady. At 10%, which is the market interest rates, at those 10% coupon rates, both of those bonds are going to be equal to 1,000, so that's that point where they're all both equal. However, if you change market interest rates one way or the other, you're going to notice a very big swing, and notice that that yellow line swings far more dramatically, and that's the main point here. And then you could also maybe notice that the coupons are going to that swing is going to be a little bit more aggressive with the lower coupon payments. Now, sort of on the flip side from price risk is reinvestment risk, and it's another type of interest rate risk. But with reinvestment rate risk, there's concern that if the interest rates fall, future cash flows will have to be reinvested at lower rates, hence reducing income. Now, what does that mean? Essentially, that means that if a bond matures and interest rates fall, I'm a little bit worried because now I have to reinvest this money at a lower rate than what I had before. All right, so now I'm going to be making less income. So let's take an example here. Suppose you just won $500,000 playing the lottery. You intend to invest this money and live off the interest. You may have a couple options here depending on how you view reinvestment risks. So first, let's take a look at what are the main points of reinvestment risk. Remember, reinvestment rate risk is uncertainty concerning rates at which cash flows can be reinvested. Short-term bonds have more reinvestment risk than long-term bonds, and this obviously makes sense, right? Because they're going to mature sooner, so you have to worry about what are you going to do with that money. So for example, I have no real reinvestment rate risk with my 401k. I can't even touch that money till later in my later years in life, right? In my 60s and whatnot. So, but if I've got some money that's about to mature right now, there's some reinvestment rate risk. What am I going to do with that money? Okay. Then high coupon rate bonds have more reinvestment rate risk than low coupon rate bonds. So both of these points are opposite of price risk. Why would high coupon rate bonds have more reinvestment rate risk? It's because I got a good deal going, but I'm worried that when I reinvest it that I'm not going to have such a good deal. All right? So if you know that you've got a sweet deal lined up and you're making 10% on some CDs, and you've been seeing what interest rates have done, you're probably worried that you're not going to be able to get a CD for at 10%, and you're not going to get anything close to that, right? Okay, so let's take a look at our scenario with our $500,000 lottery win. Now, you've got two options here. You may invest either in a 10-year bond or a series of 10 one-year bonds. Both 10-year and 1-year bonds currently yield 10%. So if you choose the first strategy, the 1-year bond strategy, or I guess I should have said the second strategy, but if you're going to choose this 1-year bond strategy, after year one, you receive $50,000 in income and have $500,000 to reinvest. In other words, you're just taking the interest you get for that year. So if the 1 year rates fall to 3%, your annual income would fall to $15,000. Whereas if you take the 10-year bond strategy, you're going to lock in to this 10% interest rate over the whole period of time, and that $50,000 annual income, you're going to get that each year for 10 years, assuming that you don't have some strange protective covenant or anything in the bond such as making the bond callable. So it should be pretty obvious that with the 1 year bond strategies that you have less price risk, and with the 10-year bond strategy you have less reinvestment rate risk, right? So what is the conclusion when comparing price risk and reinvestment rate risk? If you look, price risk is going to be a concern with short-term, excuse me, I said that backwards, with long-term bonds, okay, and or low coupon bonds. Reinvestment rate risk is going to be a big concern with the short-term and or high coupon bonds. As long as you can remember those, this little graph right here kind of keeps it all together, then you'll be fine. And in fact, this is two of the first major points of something called Machiel's 5 theorems about bonds, and you won't learn about that until you take an investment class. But when you do, and you hear about it, remember, oh yeah, that's right, in Finance 3020 we talked about price risk and reinvestment rate risk, and so this is theorems 1 and 2 pretty much of those 5 theorems. And also remember, you can't get out of risk, unless you find some kind of crazy arbitrage opportunity, which is a word you might not need to know just yet, but almost everything that you do in life is going to have some risk involved. Now, if you'd like to look at a couple of conceptual problems, you could look at problems number 22, 23, and 38 on your test guide, and that can give you some idea of what type of problems I might ask concerning price risk and reinvestment rate risk, and what the difference or sensitivities between short-term and long-term bonds are, and high coupon and low coupon bonds. Okay, so let's take a real quick look at semi-annual bonds. Now, the only difference here really is that we have gone from annual payments to semi-annual payments. Now, you can use your bond cheat sheet, or you can also look at how I've laid it out real quick right here. If you're dealing with years, you would multiply those by 2 to get the number of semi-annual periods. If you've got an interest rate, you're going to divide that by 2 to get the semi-annual periodic rate, okay, or the semi-annual yield to maturity. And if you've got an annual coupon, you would divide that by 2 to get your semi-annual payment. Okay, as long as you can remember that, and then you understand inputs. Now, the outputs would be the exact opposite as far as multiplication and division. And as long as you understand that, then we're good to go. So what's the value of a 10-year, 10% semi-annual coupon bond if R is 13%? Okay, make sure you multiply your years by 2 here. So you got 20 for N for semi-annual periods. Your I is going to be that 13% divided by 2, or 6.5% for semi-annual yield to maturity. Your payment is going to be 10% coupon rate times par, which is $100, but then divide that by 2. And then you get $50, and then remember that par stays the same. So you solve for present value, and you can get a price of $834.72. Now this slide is somewhat interesting. It's got a lot that looks like that's going on there from a math perspective, but it's a real simple question. Would you prefer to buy a 10-year 10% annual coupon bond, or a 10% or a 10-year 10% semi-annual coupon bond? Everything else being equal. And the answer is obviously semi-annual bond. Why? Because the semi-annual bond gets to compound for 2 periods instead of 1. And so you get a little bit extra with compounding interest, 10.25% instead of 10%. So obviously you would prefer that semi-annual coupon bond over a similar annual coupon bond. And that's a pretty nice conceptual question for the exam. If the proper price for this semi-annual bond is $1,000, what would be the proper price for the annual coupon bond? So with this problem, all you have to remember is that the semi-annual bond had that yield to maturity of 10.25%. So if you make your yield to maturity 10.25%, so use that EAR there for your yield to maturity, okay, and then you keep everything else the same, right? It's 10-year bonds, so put in 10. Payment is going to be $100, because remember it's like a kind of a 10% coupon bond, and the future value is 1,000. So if you do all that and you solve for price, you're going to get a price of $984.80. And the reason this is happening is because you're kind of saying when you ask this question, uh, what would happen if interest rates went up to 10.25%? Okay, it's a similar question because effectively that's what we're asking here. So you just change your yield to maturity and you solve the problem. Now, if that I would have been 10%, obviously the price would have gone to $1,000, right? And you can do that for fun. We've been proving that all day or throughout this whole lecture that if the yield to maturity and the coupon rate equal the same thing, then your present value and your future value will both be equal to par. Okay, now we're talking about something totally different where we're talking about yield to call. I put this slide in here just for those that are curious, but this is not something that you would be tested over. You can probably figure out what the inputs are here, though. I mean, it's a semi-annual bond. It's going to get called in 4 years, so 2 times 4 is 8 for N. If you look at your present value, that's going to be the price. So you're going to plug in $1,135.90, make it negative, right, for your present value. Your payment, it's a 10% coupon rate bond, so the annual payment's 100 divided by 2, you get 50. And then your future value. In this case, you actually have one rare situation where you're not going to have $1,000 as the future value because you're calling this in 4 years for 1,050. So make sure you make that change, and then you're going to just solve for your interest per year, which in this case is your yield to call, and that's where you get this 3.568% number. However, remember this is a semi-annual yield to call, so you'd have to then multiply that by 2 to get your annual yield to call. All right, so once again, as it explains here, to get the annual yield to call, you're going to have to multiply this 3.568% times 2. That gives you 7.137%, and so that would be the rate that a broker would quote. You could also use the equation right there below to change that into the effective yield to call, because of the compounding that's going on during that 1 year for 2 periods. Once again, you don't have to do this for this exam. I just wanted to expose you to a problem about yield to call. The only types of questions I'm going to ask are some basic definitional or conceptual questions. So here's another slide that just is asking you some more information if you want to think about yield to call questions. If you bought these callable bonds, would you be more likely to earn the yield to maturity or the yield to call? The coupon rate equals 10% compared to the yield to call, which is 7.137%. The firm could raise money by selling new bonds, which pays 7.137%. So in other words, think about this. You could replace the bonds that are paying $100 per year with bonds that are paying only $71.37 per year. If I was an investor, if I invested in these bonds, I would expect these bonds to be called. So it's simply just a matter of math. I mean, if the rates go down enough, the issuer is going to call a bond. So this brings up my final question about callable bonds. When is a call more likely to occur? In general, if a bond sells at a premium, then remember that with a bond selling premium, we pretty much know that the coupon rate is going to be above yield to maturity, right? In other words, interest rates have gone down, so that makes a call more likely. So expect to earn yield to call on premium bonds and the yield to maturity on par bonds and discount bonds. It's that simple, okay? If I ask you a conceptual question, it's probably going to come from what we're looking at here on slide 62. All right, let's also look at default risk. So we got a few slides here dealing with default risk. Really, the default risk is nothing more than the chance that a company is not going to be able to uphold their obligations, right? The company might default, go into bankruptcy. The biggest default of all time, does anybody know? Well, that would be Lehman Brothers, right? Lehman Brothers was our biggest bankruptcy of all time, and it pretty much came out of nowhere. So even some companies with really high credit ratings that can default, but usually we have some good credit ratings kind of help you measure what's the default risk of a company. For example, you'll notice that our bonds are going to be rated higher than say Greek bonds, right? Because we've all seen what everything that Greece has had to do. So some important things to remember about default risk. If there is a default, you're probably going to get less than what you were promised. Therefore, you're going to have a lower expected return for, say, corporate bonds or muni bonds than you would with treasury bonds because you're pretty much guaranteed with treasury bonds. In fact, we often use the treasury bill for the risk-free rate. Okay. The default risk is also going to be influenced by the issuer's financial strength and the terms of the bond contract. Okay, so it depends on what those exact terms in that bond contract are as well. So let's go over the definitions of these different types of bonds dealing with some different types of default risk. First are mortgage bonds. This is nothing more than just a bond secured by a mortgage on one or more assets, or you could say it's backed by a pool of mortgages on real estate such as a house, right? And you can get into mortgage-backed securities as well, which goes all the way back to the beginning of our lecture when we talked about Freddie Mac and Fannie Mae and Ginnie Mae. Okay, and then once again, a debenture is just a type of debt that's not going to be secured by any type of collateral or physical asset. And then with these subordinated debentures, remember, it goes back to that word subordinate. You're talking about bonds that somehow rank lower, right? So they're going to get paid off after more senior debt issues. And then finally, we get to some unique terms such as investment grade bonds and junk bonds. And one of the things I'd like to point out here is that investment grade bonds are anything that's based on, Standard & Poor's rankings, anything that's triple B, BBB, and then up all the way to triple A. Anything below that, like BB and, down into the C bonds, those are all going to be junk bonds or what's known as speculative grade bonds or high yield bonds. And this is important because by law, a lot of, companies or especially investment banks are only allowed to invest in investment grade bonds. So once again, let's take a moment to talk about bond ratings because I'll definitely ask a question or two on your exam about this. I talked just a second ago about Standard & Poor's or S&P, and you can see investment grade goes from AAA to triple B, and then junk bonds are going to be anything that's double B and below. Moody's has slightly different letters for their rankings, but they basically mean the exact same thing. The whole point here is that they're trying to tell you whether or not, there's a chance of a default, right? And there's only a couple of companies right now that have AAA ratings. And a few of those companies are, I believe, still Johnson & Johnson, ExxonMobil, and Microsoft. I know that they were the only three AAA rated companies in 2014, so now it's 2015. That's probably still pretty true. These ratings don't change that much over time. It was a big deal when the U.S. government actually got knocked down a peg from its AAA rating, and so that created some controversy and whatnot. But for the most part, you don't get too worried until you get down close to that BBB point if you're an investment bank, because you don't want it to become a junk bond and then have to sell or be forced to sell it because it goes into junk status. Now, there's two really cool sounding terms, rising stars and fallen angels, with bonds, and what they are is, they describe bonds that have had some kind of movement. So if you are, a speculative bond or junk bond, and then you somehow get a good rating and bump up into investment grade, you're called a rising star. But on the flip side, if you are an investment grade bond and you somehow get knocked down into junk status, then you're a fallen angel, right? And that would be that'd be pretty bad, right? So rising stars would be a good sign of your credit, and then falling angels would be a bad sign of the direction that your credit's moving in. And so, that's pretty much all I want you to know about bond ratings. I've got a couple questions on the test guide, problems number 27 and 28, that you might want to take a look at. Okay, so I just put this table in here just in case you're curious. This will show you some adjectives associated with the different bond ratings. These adjectives can be everything from like excellent, strong, satisfactory, weak to vulnerable right at the bottom. And this graph also, or table, shows you some interesting numbers that they're going to be looking at, such as cash flow and your debt leverage and your debt to your EBITDA, or earnings before interest, taxes, depreciation, and amortization. You obviously don't have to memorize anything from this slide. I just thought it was interesting. Now, figure 7.4 is going to put the U.S. government bonds in the green. It's going to put corporate AAA bonds in blue, and then corporate triple B bonds in orange. And as you can see, since there's more risk associated with each step up here, that these bonds are going to get a higher yield depending on what time, for that specific year. And sometimes the spread between these is not that big of a deal, such as in the mid 90s, and then sometimes it can be very wide, like it was in 2009. Now, why would that be? Well, in 2009, remember, we just had the recession, so there was a flight to quality, and so a lot of people wanted to put their money with the U.S. government because they felt that was much safer than with corporations. Here, figure 7.5 is going to show you the relationship between bond ratings and bond yields, and this is over a very small period of time following that recession that we just talked about, right? And I think the main point I want to make here is just with the yield spread, and you can see that over that 4-year period, the yield spread has opened up, especially towards the lower rated bonds there. So you're starting to get some more of spread there when you're getting towards those lower rated bonds. If you're interested in some more information, especially about corporate debt, I put table 7.5 in here. It's going to be a little hard to see, but obviously you can go and look at it in your book. Really what I found interesting about this is it goes all the way back to our talk at the beginning about the difference between debt and equity, but you will see that sometimes here bond prices and share prices will move in a similar pattern, or that one will actually anticipate or predict the movement of the other. And so that's just a really neat little table to take a look at. I think you'll get a lot of interesting information out of that. So what are some factors that affect default risk and bond ratings? Okay, well, Moody's and S&P, they're going to have to take a look at certain specific numbers to figure out the default risk anyway. We don't know exactly what their equations look like and, what they take into consideration. But here are some things that we do know that they look at. They're going to look at the debt ratio and the current ratio and the times interest earned ratio. They're also going to look at some qualitative factors such as contract terms. Are we talking about secured debt versus unsecured debt, senior versus subordinated debt, guaranteed or sinking fund provisions, and also debt maturity. So they're going to take a look at all of this information, right, and deciding what to give a specific bond issuance as far as, a bond rating. And that doesn't mean that they don't look at anything else, right? There's all kinds of factors, and here are just a few miscellaneous qualitative factors. Are their earnings stable? What's the regulatory environment look like, and could that hurt them? Right now, in year 2015, we have been facing a lot of increased regulations from the last recession. So, is that messing with certain companies more than others? Potential antitrust or product liabilities. Do they have any kind of patents? Are there going to be any kind of lawsuits? Are there any pension liabilities? Like, obviously a lot of the big car manufacturing companies recently had to go through their issues, and still will probably, do this for a long time to come. This happens a lot with muni bonds too. You got a lot of cities that are dealing with pension issues right now. Chicago has a lot of pension issues that they need to get cleared up. So pension liabilities can be important. Potential labor problems will always, be an issue. Are they, is this company working well with its unions, or is it going into a lot of combative situations with the unions for that particular industry? All right, so this gets us into our last few slides. They're about bankruptcies, and this slide is really important. I'll definitely consider asking an exam question from this slide. So there are really two main chapters of the Federal Bankruptcy Act. There's Chapter 11, which deals with reorganization, and Chapter 7, which deals with liquidation. Now, following the recession, we had several companies that actually decided to reorganize. And a lot of times that doesn't mean that company is going to go away. That just means that that company has to get a few things together so that it can come back and, be productive and profitable down the road. Chapter 7, though, means liquidation, and that means that company is pretty much going bye-bye. So in some cases, some companies are worth more alive than dead, and some companies are worth more dead than alive. So let's talk a little bit about Chapter 11 bankruptcy specifically. This is for companies that can't meet their obligations. This is basically done just to keep creditors from foreclosing on their specific assets, and really gives them a window there, usually around 120 days or so, to file a reorganization plan. And they'll appoint somebody like a trustee or supervisor that's going to be in charge of this reorganization, but management is really going to stay in control. If this reorganization plan doesn't show that it's worth more to keep this company going, then a judge can come in and say, you guys are going to have to liquidate. And so sometimes a Chapter 11 can turn into a Chapter 7. All right, so let's say we do have to go to liquidation. Who gets priority over who else? It's important to remember that creditors usually get to go to the front of the line, and that common shareholders usually go to the back. But there's a lot of kind of folks that line up in between. So number one is going to be your secured creditors from sales of secured assets. Now, what you're going to next notice is there's going to be a lot of people that might be involved before you get down to the unsecured creditors. The trustees' costs will be in there. Wages, subject to certain types of limits. Taxes could be in there as well. Unfunded pension liabilities, and then you're going to get down to these unsecured creditors. So being an unsecured creditor is not like you're right behind that secured creditor. There could be some issues there where the secured creditors get fully paid, and there's nothing left over for the unsecured creditors. After them, you get to preferred stock holders, and then last are those common shareholders. So there's two real important points here about reorganization. One, in an event that we do go to liquidation, unsecured creditors are generally not going to get anything. So this is going to make them really want to participate in the reorganization process. In other words, they may actually decide that they'll take a little bit less if they can keep the company going, because that's the only way they're going to get anything. So various groups of creditors are going to vote on this reorganization plan, and if both the majority of the creditors and the judge approve, then the company is going to get to come away from bankruptcy with lower debts, reduced interest charges, and a chance for success. So that's really how it works. You may remember that unfunded pension liabilities were right in front of them, so you might have the unions involved as well, and they'll be willing to take a little bit less too, because they don't want this company to completely dissolve. So but reorganization is an important process that has helped some companies keep going on and adjust for some of the things that maybe they didn't see happening down the road, such as people living to be, as old as we live to be today. Okay. Now, hopefully this has helped giving you a lot of information and a real thorough understanding of bonds. I would focus most of my attention on this lecture for your next exam on bonds, and also on the test guide. If you have any questions, please let me know. Thank you. This concludes Lecture 3.2 on bonds and their value.